Welcome to another Chorus One podcast, also related to Bitcoin, as we like to do it. And today we have Aki, who is the founder of dlcLink. Welcome, Aki.
Thanks for having me.
Pleasure. Thanks for joining. Cool. Then maybe it would be great to start with a small intro on your side. What were you doing before DLC, and why did you decided to go all in and start dlcLink?
Yeah, absolutely. I guess just a bit about me. I've been writing code for almost 30 years. I turned 40 next year, so I started when I was about 10 or 12 was when I learned Perl. I was a developer. I was a management consultant, private equity, venture capital in 2011 in Boston, looking at AI, big data, marketing automation. I then started an AI marketing automation company where I invented a way to use machine learning to optimize content for search. And I built that into a company. It was called Market Muse, or is. They're still around, but it became the market leader in marketing in content, AI content optimization back in 2013. So I raised over 10 million to do that. I built the team, kind of did the whole startup thing for 8 years. And I actually heard about Bitcoin in 2011. I was already kind of busy on the AI side, so I just didn't really look as deep into it. And long story short, 3 years ago, after working on the same problem for 8 years, I wanted to do something different. I came to crypto. Actually, a friend of mine I started hanging out with a friend of mine who's done really big things in crypto, and I just got more interested. Then I started taking the MIT open course class on Bitcoin and the other crypto, and basically just decided to build on Bitcoin. This was 2021. Was when I started dlcLink. And basically the original goal was, I thought Bitcoin, of course, everybody in crypto already knew this, but for me kind of coming into it fresh, I thought Bitcoin was the most secure asset. And when it comes to financial technology, the number one thing is don't lose people's money. So security is critical. And then I noticed that, if you want to take a loan or invest your Bitcoin, there just really were no DeFi options. It was only pretty much mostly CeFi, or you could bridge it somewhere, or you could wrap it by sending it to a custodian, which of course is also not decentralized. And so I started to invest, and actually I cannot claim I did not invent the DLC technology. That was created 6 years ago by the creator of the Lightning Network, Tad Strija at MIT. He's the guy who teaches the MIT Bitcoin course that I was watching. So he had created this concept of a DLC, and I thought this could be something that could actually solve this problem and make Bitcoin liquid to use in DeFi on Ethereum. Specifically, I have some Bitcoin miners. I was getting Bitcoin. I wanted to take a loan in Aave, and I had to use WBTC, and that just didn't seem like a good idea. So basically, I started dlcLink with my co-founder Jesse in late 2021, and then as soon as we started, we got a grant from ChainLink to investigate the concept of Bitcoin oracles, and then we went from there.
Okay, yeah, it's definitely clear that you like to be in the frontier with AI, investing, and now of course crypto. So yeah, maybe then it would be great to know why a Bitcoin bridge, why using DLC, and we've talked quite a lot about Bitcoin in the past few podcasts, and it always seems like the most scary challenge is Bitcoin bridging. So keen to learn more. How do you plan to solve this challenge with DLC?
Yeah, totally. And I can even add to it. We're live. We're live on Arbitrum and soon other chains. Yeah. So we have solved this problem, but few people know about it. So thank you for your help in that. Yeah, look, when we looked at it with my co-founder Jesse, who used to be at Twitter for a long time, kind of grew up in the West Coast, so he's a great product builder. When we looked at the problem, we basically realized, this might be a tried statement, but I think all bridges are destined to fail. Bridges have a couple of issues. One is just throughput, like how do you bring enough value through it? But more importantly, it's the construction of the bridge. It's like an open invitation for anyone to hack it. I mean, it's basically you're arbitrarily moving value from one address to a new address. And these, of course, the function of a bridge is to provide a new address, now move it here. So there are so many, attack vectors there. And I'm not a security expert, but, when we looked at that, it just there's always a way to inject a new address, or there's always a way to hack any system, given that it's open source, and and especially as the bridges scale to large levels, the reward for hacking just gets greater and greater. So in our view, bridges are just not going to work. They might work in small ways, and there are many use cases for for retail maybe, and so on. But when we think about especially institutions scaling, it's just not going to work. And in the same way, custodians are not going to work, because that's the whole point of crypto, right? Is to not have a centralized custodian, because the custodian becomes the central point of failure. And so what attracted us about DLCs is that DLCs are on Bitcoin L1, and they are actually fully non-custodial. In the way that they were described in the DLC white paper years ago, it is basically just it is a trustless interaction, or maybe trust minimized might be a better word. Basically, and I'll just explain the DLC concept. You have, let's say, Alice and Bob. They want to do like a bet, like a sports bet. They each put up, let's say, 1 Bitcoin, and you have this off-chain entity called an oracle. The paper says Olivia the Oracle, who basically decides who wins the game, and then either Alice or Bob can get the Bitcoin based on that input. And the oracle does not know who Alice and Bob are. The oracle is just publishing results, so there's a level of privacy there. This was the original kind of concept. The problem or the challenge with DLCs is, who is the oracle? Like, who does Alice and Bob trust to serve the result? And we basically, to kind of shorten it, we realized that if the user wants to wrap Bitcoin to another chain like Ethereum, there is only one oracle they can trust, and that is Ethereum. The entire Ethereum chain, the set of Ethereum validators, is the off-chain data source into that DLC. So ETH exists as the off-chain into the DLC, which is secured on Bitcoin. And I forgot to mention kind of the key part of this is, when Alice and Bob make their deposit, they pre-sign all of the potential outcomes. And that's where, that's kind of the hallmark of the system. So Alice puts a Bitcoin, Alice and Bob are like, hey, we're going to make this bet. There's one outcome where Alice gets all the Bitcoin. There's another outcome where Bob gets all the Bitcoin, and maybe a third outcome where they split it evenly or whatever. But when they make the deposit of Bitcoin, they pre-sign these, and they trade signature. They generate like pre-signatures, and then that's when the Oracle data comes in. That's what unlocks that potential conditional outcome. And so we basically took this concept, and there's a couple of challenges with the concept, especially like who's the Oracle and who's Alice and Bob, and we applied this basically to what we call self-wrapping. This is a term that we coined, where basically Alice locks with Alice. The Bob is not relevant in this scenario. Bob is not putting Bitcoin. Bob cannot get Bitcoin. Alice locks with Alice, and the Oracle is Ethereum blockchain, which basically says, there's an attestation, like Alice locks with Alice to mint dlcBTC, which is an ERC20 on ETH. When that is burned, Ethereum chain validates the burn and then sends this attestation over, and then Alice can retrieve her Bitcoin. And that's what we've been. And so we're basically using the DLC as a locking mechanism on Bitcoin. We're just locking it, or we're not locking it. Alice is locking it with herself using software. She's not sending Bitcoin to us. We're not a bridge, but she just self-wraps, gets the ERC20. When it's burned, it unlocks.
Okay, yeah, I think that's a fantastic overview of how it works on high level, and also like the relationship between DLC and DLC Link that you went over. So maybe just to clarify that you mentioned that one of the bigger differences is the oracle and who is the oracle. And then at the start, you also mentioned that you initially collaborated with ChainLink. Is there still a link going on there where ChainLink is helping you guys or collaborating for what the oracle is that you mentioned? It should be the whole Ethereum network.
I'm glad you asked, because that was for us a kind of like an adjustment in our mindset. In the beginning, ChainLink gave us a grant to investigate Bitcoin oracles as this potential service offering where they could pipe data into Bitcoin. And we realized that doesn't, although someone might build that one day for reasons that I don't know, but that's not what the design should be. Actually, the entire network should be the oracle. And then on top of that, you can have ChainLink products for different types of oracle providers. So for example, dlcBTC is an oracle-free solution in that you put one Bitcoin, you self-rep one Bitcoin, you get one dlcBTC. So there's no, sense of price. But of course, once you have dlcBTC, you want to put it into Aave or, other DeFi, then you do need a price feed. But the price feed could potentially be Bitcoin price, because it's just a representation of the underlying asset. So the on ETH and on the different chains, ChainLink is a valued partner, and we can use their solutions there. But for the wrapping, the self-wrapping mechanism, there are no moving pieces. There's literally only Bitcoin chain, and there's Ethereum chain. And then we had to add one thing, which is a set of relay nodes, we call it testers, that relay the signal between Bitcoin and ETH, because of course the two chains don't talk to each other. So we just have a set of node operators, and they each run a Bitcoin node and an ETH node, and they have a Bitcoin private key they use for message passing. But basically they cannot get Bitcoin. So they're just relaying. It's a little bit more like a Nostr relay in terms of like what it is, but we're not a chain. We don't get custody. The nodes don't get custody. The custody only stays with Alice, or the depositor, and it is a theft-proof system. That no one can ever get the Bitcoin, because Alice has only pre-signed herself to receive the Bitcoin, and that cannot be changed unless the entire Bitcoin network is hacked.
Okay. Then you touched on a few interesting points, but I think maybe just let's take a bit of a step back and walk through kind of the network participants in a transaction. So if you could guide us through how a transaction works from end to finish. Okay, so you mentioned Alice, the initial user. You also mentioned testers, which I would like to go a bit deeper on. And also, if you could explain how everything works with the Bitcoin L1, that would be fantastic.
Yeah, definitely. Yeah, let me start with the third part of that first, because I think it's the most interesting. I think the biggest untold story right now is that DLCs are something that, DLCs exist. They were added to Bitcoin 2.5 years ago with Taproot. They use Schnorr signatures, so they need Taproot for Schnorr, or added support for Schnorr. But DLCs are a permissionless layer. It's primitive that's on Bitcoin that anyone can build applications with, and it's out there. And so there's a DLC community. There's maybe, about 10 or 15 companies that are designing DLC-enabled applications. But the point of the DLC, or the strength of DLC, is that it is on Bitcoin L1. I now have started telling folks, Bitcoin does not have smart contracts, but it does have discrete log contracts, which are like a pseudo-programmable. They're like a simple interface that you can program in. And they are like an if-then statement. So basically, if, and then there's an off-chain condition. If true, then here. If false, then there. It's like if-then or if-then else. So you do have that on Bitcoin, and we've had it for 2.5 years. And there are only maybe 15 teams that are building DLC solutions. Meanwhile, everybody's bridging and sending their Bitcoin to elsewhere, and not your keys, not your Bitcoin. As soon as you send the Bitcoin somewhere else, it can get hacked or stolen or something back in happen to it. So DLCs, in my understanding, are the only way, pretty much, today to lock Bitcoin into self-custody and have, some sort of logic governing that. The only other way, I guess, is a time lock, which is what that one uses. So I guess that's maybe the highlight. Maybe I should pause there because I think that's the alpha.
Yeah, no, and that's definitely super interesting, and I think a very strong link to make is that it's been live since Taproot, you mentioned, and it's kind of the only primitive way to, let's say, program, even if it's a bit simpler than smart contracts on Bitcoin. So then you have this layer one interaction with Bitcoin. You also have attesters, which we could maybe touch on next.
Yes. So basically, the attester is a concept that we invented, or it's a term that we coined, because in the DLC parlance, you have the Oracle publish an attestation. And so the DLC there's an Oracle announcement and an Oracle attestation. So Oracle announcement when the DLC opens, Oracle attestation closes the DLC. But we don't have an Oracle because it's an Oracle-free solution. Because for us, all the Ethereum on-chain signals are the Oracle. That's how we solved the quote-unquote Oracle problem. So we had to come up with a new term because we didn't want to call it a DLC Oracle. People might think there's a source of data like that, like we are the source of data, or there's external source of data or ChainLink. So we had to come with a term that just differentiates this relay network. And because it publishes an attestation, we named it an attester. So it's kind of a simplification. But what the attesters do, and there's a couple of them. Right now we have 7. We're going to move up to 15, and then maybe stop at 15. We don't need a lot of them because it's not a chain. It's not creating new validators. I guess quick sidebar, when you create a chain, you start with 10 validators, 50, 500, and it moves from there. And of course, the validators kind of lend the security of the network. If you're just using existing validators like what we can launch on Arbitrum, then we use Arbitrum validators, launch on ETH, it's ETH, Cosmos, and it's those validators. So because we don't have to create the validation layer, we have the security, dlcBTC offers the security of that chain, but you still need to relay the message. So these attesters, they basically run a Bitcoin node, a full node, an RPC, and they run a RPC, a node of the chosen chain, and they each custody a Bitcoin private key they use for signing a message. And so when you have 7, then you need a 5 of 7 threshold. You need 5 of them to sign the message. Basically, the messages can be one of 2 messages. One, like this UTXO on Bitcoin is funded. So this UTXO is a DLC and it's been funded. I attest that it's funded. You sign, 5 or 7 mints the dlcBTC on ETH, or the dlcBTC is burned. There's a bunch of stuff that happens on the MEV, like stuff that I don't even know. Whatever comes to be an on-chain signal. Yep, I see that on-chain signal. Yep, I attest to it. And of course, anyone can validate this. So any third party can validate that the attesters are attesting truthfully, but just to have various forms of decentralization, we have multiple attesters, and so they sign this, they just sign the message, and then it's just the message passing system. And so there's one risk with that. I mean, of course, none of these are trustless systems; these are trust minimized systems. But the one attack vector that adds is not hacking or is not theft. Like if hackers capture the attesters, then they still cannot get the Bitcoin. They cannot steal because the attesters don't get custody, but they can collude. So if the attesters form a cartel, let's say, or if all the attesters are hacked by one group that gets control, they can censor the unlock. So the depositor has put Bitcoin in, mints dlcBTC, burns the dlcBTC, and the unlocks relay signal is censored, and they cannot get their Bitcoin back. And then they do like a ransom attack, and they have to pay. So in order to protect against this, we are further decentralizing the attestation network.
Okay, got it. Yeah, and via this, you essentially never have Bitcoin leaving the DL1
Correct. In fact, it cannot leave the user's wallet. Because the in dlcBTC, Alice has a wallet address. She makes the deposit into a multi-sig that can only pay out to her. She pre-signs one conditional outcome that the Bitcoin goes back to her, and whoever owns the private keys to that wallet, that's the only person or institution or entity that can ever get the Bitcoin. It is impossible for the Bitcoin to go anywhere else unless the entire Bitcoin network is hacked. But it is impossible because they're just locking it with themselves. It's a special form of self-custody.
Okay, yeah, that's already super cool. And also, I thought it was interesting when you mentioned that you don't really need validators, and when you want to kind of bridge to a new chain, you just tap into the validators or the operators of that chain. In a way, it reminds me a bit to IBC, but in terms of scaling, would it be the same? Like, let's say if you next want to go to Solana, you will have to implement the Solana validators, and it would work similarly.
Exactly. All we need to do is we need to ask our node operators, which are firms like HashKey Cloud and OKX and so on. We just need to ask them to run a Solana node, and of course they usually are. So we just need to ask them to point to their Solana node and use the same Bitcoin private key to sign the messages. Basically, we can launch to a new chain within hours once they update the software, ready to go.
Okay. Yeah, that's super interesting. And then maybe just to conclude on the transaction, like path flow, you also have the user, and from the eyes of the user, they're just clicking and signing first a partial transaction, and then do they have to do anything else?
So this is where we get the most questions, actually, because now, especially now, people are so accustomed to Bitcoin L2s, where it's like, hey, I'm a permissionless, anonymous person. Let me send my Bitcoin to this L2 or send it to whatever. Our system does not work that way. We have a set of permissioned set of what we call merchants, who are typically institutions, can be Bitcoin miners, can be high net worth, but they're entities, named entities. And let me explain why. Because usually the number one question is, cool, how can I mint dlcBTC? Well, unless you onboard as a merchant, you cannot mint in this system. And the reason is because of redemptions. So think of us, take a step back. Think of us, we're like USDC for Bitcoin. Circle has a bunch of banks like Silicon Valley Bank, Wells Fargo, etc. They each put out $USD to mint USDC, which is a fungible token that retail can use. We use it, of course. But if something happens to SVB, there's a loss of consumer confidence and the token depegs. So there is a counterparty risk there. Basically, you're reliant on the solvency and the availability of those merchants who are minting it. In the same way, if let's say if a retail user, an individual, would permissionlessly lock Bitcoin into a DLC, they are the only person who can ever get that Bitcoin. And let's say they trade it, or they lose their private keys, or something happens, they might not be able to redeem it. And so then the people holding dlcBTC are subject to this unknown counterparty risk that, basically, in that scenario, dlcBTC might not be fully redeemable, which we don't want to even go down that, line of thinking. So instead, we're building the same merchant system, similar to what USDC has, or actually BitGo with WBTC has this merchant system. They have about 70 merchants, which are institutions that are whitelisted to be able to mint WBTC. So we have this, but in our system, in the BitGo system, they have 70 merchants that all send their Bitcoin to BitGo in one centralized custody, and that's the only place the Bitcoin can be held. In our system, the however many 70 or hundreds or however many merchants we have, they each lock with themselves. So there is, the risk is basically spread out, and it's semi-decentralized. And the more merchants we have, the more that the risk is decentralized.
Okay. This is a very interesting point, and I think maybe walks us to like my next question on other solutions and comparisons. So the way I understood it is when you're minting DLC, you have the unique guarantee that it's always going to be locked in Bitcoin, and in Bitcoin is also kind of in a self-custodial manner, whereas in other solutions, like for example dlcBTC, this issuance and Bitcoin is first sent to a centralized provider who then mints dlcBTC. Is this more or less correct?
Exactly right. Yeah, basically you have a custodied approach like dlcBTC, where or you have a bridged approach where you either send the Bitcoin to BitGo or the custodian, or you send it to a bridge and their nodes custody it. But those are pretty much the 99% of the options except Babylon, which I think we'll cover later. But basically, yeah, that's right. The challenge with the custodial model is the deposits they have limited insurance. So there's no like FDIC in the US. Bank deposits are certified FDIC insured up to $250,000. So if something goes wrong, the federal bank bails you out. In crypto, does not exist by design, of course. And BitGo has some insurance, but it doesn't. It has limits and so on. And then the other problem is BitGo is a US entity, so it is not. It cannot claim to be censorship resistant because you're sending your Bitcoin to a US entity that is subject to US laws. It's a US trust company. So, anyway, BitGo is a great custodian. We love them, but they are just one centralized custody. I guess those risks are known. Bridges, you have to send it to a set of nodes, and whether you have 60 nodes like threshold TBTC, or if you have 600 or 6,000 nodes, whatever it is, those nodes follow a certain design principle. So, for example, a lot of the Bitcoin L2s have forked the OP stack, so they use the OP bridge. So they might have a correlated risk there, because if there's a way to hack the OP bridge, let's say like you just have a bad commit. Let's say a developer commits code that exposes a vulnerability. Some malevolent entity or malevolent AI entity finds it and exploits it. Boom! Not just that bridge might be hacked, but all of the associated bridge technologies might have that vulnerability. This does happen from time to time in the internet. We've seen like AWS go down. We've seen things go down when they get correlated. So anyway, that's not your keys, not your Bitcoin. That's another known issue. Yeah. Okay. So in this here, it can only go, even if hackers, whether they censor the unlock or they force an unlock, no matter what, the hacker is not getting that Bitcoin. It is impossible unless Bitcoin itself is hacked by quantum or something crazy.
Okay. Yeah. Makes sense. So maybe to summarize, you have like the kind of custodial format where, of course, the main risk is centralization. Then you have the one that we've seen pretty commonly in crypto, which is kind of the peg in, peg out bridge solution, that here you are relying on some design techniques that essentially are not Bitcoin. And we've seen hacks in crypto bridges, but we've never seen hacks in Bitcoin, which that should give you some sort of guarantees. So then just to clarify a bit further, my follow-up question would be like, what happens if the attesters collude with each other? Similarly, would this be similar to validators colluding in a standard proof-of-stake network, or how is it different?
It is a little bit. It's a lower risk profile than a validator. A validator colludes and they can just grab the funds and go. In this system, let's say you have the 5 of 7 and Hashkey, OKX, and whomever decide to form a cartel and collude, or maybe they're hacked and they're all hacked individually in the same time frame, which is kind of hard, but of course nothing's impossible. Well, then they would either not form the DLC, in which case no Bitcoin gets put at risk. You want to make dlcBTC, but the attesters are not executing your request, so there's no Oracle announcement. So that's the same simple case, no loss there. Or the lost scenario, of course, is you put you're a merchant, you self-wrap your Bitcoin, you get the dlcBTC, you burn it, and it doesn't come back to you. That's the scenario. And then, of course, you're just kind of in a stuck. It's stuck. The Bitcoin's still there. It's waiting for that signal. The signal has happened on ETH, but that attester set, if they have a threshold, we don't have a commanding presence on this. We run one attester, but we're just one of 7 or one of 15. So if a majority of the network chooses to do that, then basically the Bitcoin's stuck. The Bitcoin is stuck. The BTC been burned, but the Bitcoin is just stuck there unless we get either different attesters or whatever. So basically, it just puts it in a stuck state. And while it's stuck, the attesters might choose to extract a bribe or a ransom from the depositor to get it unstuck. And if they don't, it's just sort of stuck there.
Okay, so there's no real risk of stealing, and here the approach would be, as you mentioned, bribing, which already is kind of a superior model to the standard proof of stake. Okay, yeah, so that's also very interesting.
And I'll just add real quick, I just saw an article last week, if the top 3 ETH restaking or staking DAOs collude, then ETH is he's going to have some challenges, and I think it was 30% threshold or something like that. So yeah, this is 100% the theft proof system. That is physically impossible. It is not a risk-less system or trust-less system, but it is trust minimized to an extreme degree that no other competing solution can claim to deliver. And that's what we wanted. And it scales because, you want to wrap to ETH? Great, boom, ETH. You want to wrap to Solana? Boom, you trust ETH, you trust Solana, great. We have this network that executes your instructions. It is a very scalable, because that's the other problem with bridges. You have to scale the bridge. Here, we're not scaling the bridge. We're just, we can, if someone wants to put $100 billion of Bitcoin and wrap it to ETH, they can do it in one Bitcoin transaction, whatever they want. It just goes. There's no bridging actually happening. So we are in the category of bridges in that we're enabling Bitcoin to be relayed to otherwise, but it's more like a teleporter. It's not really a bridge design.
Okay, yeah, and that's very clear. And I think I've seen you talk about slashing as well, and how it could reinforce the layer of attesters. So I think you will also have a DLC token. Is this mainly to reinforce this layer? Does it have any other functionalities?
It's absolutely just to reinforce the layer, because right now, why did our node operators, like I mentioned, our hash key and such, they have reputational risk. So why would they not collude? Because they would have a loss of reputation in the market. But of course, there's better designs out there, and of course, a common design is to have attesters stake, the DLC token, which we're launching near the end of the year, stake the token, they can earn fees in the token, and if they fail liveness checks, or if they fail other kind of, if they don't behave according to the policy, then they get slashed automatically by the system, so that it enforces adherence to the policy. Collusion is an extreme one, but even failing liveness checks, if the nodes go down, basically nothing happens. You have to restart the node, but it provides a poor user experience, because maybe I want to unmint and I get an error, and then it's just try back 10 minutes later. We don't want to deliver that. So the system would slash any attesters that are frequently failing liveness checks, things like that.
Okay, yeah, and I think you bring a great point that we often also comment on, that people forget, is that validators, in this case attesters, their main priority is, of course, reputation, and slashing is just one outcome that you just have to kind of guarantee high performance to avoid it. But of course, if you try to act maliciously, basically the validator company would be done in a few weeks, because no one would trust you, right? And that's something that people don't normally talk about, but it's obviously super significant. But I think maybe just to deep dive a bit more on the token, will you have a form of staking to operate this slashing, or how do you think? And also, if you could talk a bit more about the incentives and how they work, that would be great.
Yeah. Our current design is quite, I would say, simplistic. It's a very standard. We've borrowed from kind of validators and Oracle networks. It is. Now this is going to be confusing maybe, but it is an Oracle network in the sense that it's a source of off-chain data. Typically when people think Oracle, they think price feeds and ChainLink and that kind of thing. This is a DLC, a tester Oracle network, but technically, just like how we're not a bridge, but in the bridge category, we're not in the Oracle category in that sense. But anyway, we can borrow just from other Oracle networks in this design. So basically, testers can just, if they want to join the network, they can buy the DLC token, or get a grant from the foundation or whatever. They can acquire the DLC token, stake it, and then they can earn fees in the DLC. Where do the fees come from? It comes from bridge fees. So just like dlcBTC and any kind of wrapped Bitcoin provider, the system takes mint and burn fees in the form of Bitcoin when the system is used, and that Bitcoin then goes to the DLC foundation, which then can redistribute it in the form of DLC token, and then that injects the bridge. So basically, the oracles are getting paid for the successful attestations, and their stake is slashed when they are, not doing their job.
Okay, yeah, that's super clear already, and we mentioned it before, and I wanted to touch upon it as well. For example, we had a chat last week as well with Babylon, and I think it has some similar concepts which are very interesting. We're talking about Bitcoin not moving. For example, Babylon has this concept on called remote staking, where the Bitcoin staking is locked. The Bitcoin asset is locked in the L1, and I think you've mentioned some similar concepts. So yeah, curious to learn your thoughts on that, if you see any similarities as well, and yeah.
Yeah, it's an interesting question, especially, Babylon has not launched yet, but they are, very popular protocol, really interesting design, very unique. I'm a big fan of the team there, in that they're building something unique. I think we and they are very similar in that regard. We're both building something that is kind of a one-off or unique design. A couple of differences. I guess the main differences are, one, they are enabling a permissionless, locking system. But in order to do that, they have to have a condition where they can slash the Bitcoin. So the Bitcoin in their system, it can go to the Babylon side, and hackers or malicious actors could exploit that system to grab the Bitcoin that is deposited into the system. So I guess the one thing that Professor said, and I disagree on it, just listening to that podcast too, is he calls there's a trustless system. Theirs is not a trustless system, because you are trusting the Babylon staking mechanism and the mechanism behind that. So it might be trust minimized to varying degrees, but we cannot say it's a trustless system. In our system, there's no slashing. I mean, the only way to have and even ours is trust minimized because of the ransom attack. But anyway, there's just absolutely no scenario where we don't support slashing. It just doesn't exist in our system. But they, on their side, because they do have that, they can take retail deposits. You don't have to worry about the counterparty of the retail, person being there. So theirs is more B2C focused. I would say ours is more B2B in terms of the mechanism. I would say the other big difference is that we leverage composability. We're not building any new chains. We're not building any new staking or restaking protocols. We just plug into the existing ETH, Cosmos, Solana, Polkadot, whatever chains are out there. We just plug into that because we believe that we're like a transport layer. Wherever Bitcoin holders want to go, we just want to enable that. We don't censor, we don't make any judgments based on, are you sure you want to go into that protocol? We don't even know because it's permissionless. We enable the Bitcoin to go to another chain by making sure the attesters run those nodes, and then the users can put it into protocols of their choice and earn yields of their choice. And Babylon, of course, has built this whole big mechanism that's kind of like their system, versus we just leverage composability.
Okay, yeah, I think that's super interesting and definitely something to deep dive on. But for the sake of time, I think we briefly touched upon it as well. And of course, we are seeing many emerging Bitcoin L2s as a narrative. We saw it happen in Ethereum a few years ago. My question is, within this Bitcoin massive L2 landscape, we touched upon Babylon briefly. Where does dlcLink sit? And also, do you think it's the end game, or will things start moving back to the Bitcoin L1?
Well, this is now, I guess, we will launch on any chain. So Bitcoin L2s, we talk to a lot of Bitcoin L2s, and some of them are interested in having dlcBTC on the Bitcoin L2 to enable a more trustless asset, wrap Bitcoin asset on their chain. So we will gladly pursue, and if anyone has a Bitcoin L2 or any chain, just reach out to us and we can get dlcBTC on that chain. So we're not we're not selective there. I would say, this is my personal opinion, just based on what I've seen today. I think right now, ETH is the best chain for DeFi. It's got the most volume. It's got the most, usability. I realize the statement might be a little bit anathema on the building on Bitcoin space, but I just think as fact, it has the most trades. If traders want to go into Deribit or whatever, they use ETH to, EVM to do that. And they can also use non-EVM, but basically, I don't think we have to necessarily build new chains to take advantage of Bitcoin liquidity. But that said, that's just the limitations of today's technology. So, right now, DLCs are in Bitcoin and they are live. So we are using that mechanism I mentioned moments ago, not moments ago, like the beginning of the podcast. We're live on Arbitrum. The first and biggest institutional mint happened last week with Amber Group minting $1 million on Arbitrum. So there's dlcBTC on a curve pool. You can swap for it. So that is all live because of the wonders of composability. We didn't have to build all this other stuff. We just built the one thing that we're specialized at. So right now, that's the landscape. In the future, if there's BitVM or if there's, OPCAT or CTV or like all the other stuff that, building on Bitcoin folks like us also like to track, there might be new features, there might be new things. When there's, new things, then of course you'd have to build a new DeFi ecosystem and get traders to trade. And it'd be a new thing. But in the meantime, we took the position that we don't know we don't know where Bitcoin holders want to go. Most likely they want to go to ETH because it's just got the most stuff on there. It's got most opportunities for yield. I mean, at the end of the day, Bitcoin holders want safe yield, and that's what we're attempting to provide through this mechanism. But if there's another chain, or if there's another approach that's even better, we will gladly support that. And so we try not to take an ideological position on who's going to win. Whoever has the greatest demand, whoever our customers demand, that's what we will prioritize next, and that's it. So I think in the future there will be a lot more interesting angles to this. There can be DLC technology. In fact, anyone who's thinking of building a startup, I highly encourage them to look at DLCs, because I think DLCs have a lot more designs than what we've implemented with dlcBTC. So I think the landscape is great. But for now, we have a current problem of all this Bitcoin liquidity safely earning yields without bridging or wrapping. That's what we want to learn.
Okay. Yeah, I think awesome description, and also it gives a sense that of course there's many Bitcoin L2s, but these may provide some features, but most of these features you can already see them on Ethereum, and of course Ethereum has quite a lot of advantage in development and other features that you can build on. So essentially having a bridging solution that's safe and people trust can be beneficial to other Bitcoin L2s. But if you already have it in Ethereum, it begs the question, why do you need more? But yeah, thanks so much. I think we're a bit over time, so maybe just to wrap up, not sure if you can give us some exciting alpha on what's next, or anything else that you would like to wrap up with.
Yeah, I can. I'll try to keep it short. I like to joke that the alpha when I go on interviews, the alpha is that this thing was invented 6 years ago. 6 years ago. and it's been there for over 2.5 years, and very few people notice. So that is the alpha. But we are making some announcements soon. I cannot exactly say, but an Ethereum L2 that we respect has chosen us as their wrap Bitcoin provider. So there will be an announcement there. There's some really exciting announcements coming out with our partnership with ChainLink. We will gladly partner with any Oracle provider. We just happen to work closely with ChainLink, and they will, they can describe in their own words, but I think they see what we do as a unique solution to this bridging problem. So I think we're going to have some more press releases coming out there. And then, just expect us to launch on multiple chains through the summer. Like I said, it's super easy for us to launch on new chains. So it really is not a technology problem. It really just has to do with finding a liquidity provider for the chain and getting a DeFi protocol that can provide yield, and just kind of marketing that. So yeah, gladly, if we're not already talking, we'd love to talk to all the chains, all of the DeFi protocols that can provide yield on wrap Bitcoin. We'd just love to get this rolling. And I think by the end of the summer and this fall, going into when we launch the DLC token, I think we're going to see a lot of progress very quickly made, because the wonder of composability is everybody can contribute to this. We don't need to build our own chain. We don't need to build our own ecosystem. Let's just make everyone successful, get Bitcoin liquidity into protocols that can provide superior yield, restaking yield, whatever, and boom, we're there. So I think we're going to have a very eventful summer.
Yeah, fantastic. Well, thank you so much for coming today, Aki. It was super interesting to learn more, and super excited about these new chains and about what you're doing in general. So thank you very much.
Thanks for having me.